for it.
Yes.
I'll just see. We've got 51 and it's continuing to rise, so sometimes you'll find that people come in a bit later. Okay, everybody, welcome to tonight's Scottish Property Podcast live Zoom call. We do this every Monday night at 8 p.m, so thank you very much for joining. This week has been kind of spurred on, this week's topic's been spurred on by a post that I did on Facebook a couple of days ago, just talking about the current market and how I was finding it quite difficult to find good buy-to-let deals in Glasgow. And we had a huge response on that post, and a lot of people were experiencing the same thing. So we thought it'd be good to come on here and chat tonight. We've actually got a couple of guests on for the panel tonight as well, so we really appreciate. We've got Michael Maloco who is on, and we've got Chris Wood as well. Now, I'll let them introduce themselves in a minute, and we'll get on to that. But first of all, Stephen, I just wanted to give a quick bit of news that I saw, just picked up on the last couple of days, which a lot of people find this quite interesting. And I don't think it's been talked about much on the group. I was doing a little bit of research about this announcement from Richie Sunak about the capital gains tax review. I don't know if you've heard about this. This is a little bit worrying, probably a bit worrying for some landlords and property investors. So basically, because the government have put out so much money, there's a huge deficit obviously, and they're going to need to claw back some money into the public purse. So basically, they're looking at taxes. One of the things they're looking at is capital gains tax and how they can reform that. And they're talking about this review to take place in October this year. So this will be interesting because a lot of people are saying, well, where are they going to look to first? And a lot of people are saying they're going to look straight to property investors, landlords. Obviously, traditionally, you don't pay capital gains tax on your main residence if you're selling it. But obviously, if you've got a second home or you're investing property and you sell and you make a gain, then obviously you get like a £12,000 or something. You get an allowance, tax-free capital gain tax allowance. But some people are saying that they might look at that allowance and possibly do away with it or reduce it to get more tax out of you. Some people are saying, well, you're paying I think it's 18% capital gains tax in the low rate, and I think you pay 28% in the higher rate bracket. Some people are saying, well, that should kind of marry up with your, say you're paying 40% tax. If you're a high rate taxpayer, you should be paying 40%, capital gains tax, that sort of thing. And then there's a whole thing where at the moment, a lot of landlords are incorporating into limited companies, transferring all their properties over. And at the moment, there's some, what's it called? There'll be other people in the call who know more about this than me, but when you transfer the properties from personal name into limited company, there's some sort of way where you can mitigate the tax, the capital gain, and there's some sort of allowance, which basically allows you to either pay less tax or none at all. So they're also going to be looking at that as well. So it's something to keep your eye on. I don't know a huge amount about it. I just did a little bit of research tonight. If Brian Wright's on the call, maybe he can jump in at the end and explain a little bit about it. If you're thinking about moving your properties from personal name into limited company, a lot of people are saying, do this now urgently, as quick as possible, because there's talk of that really possibly being affected later down the line. And it won't kick in until 2021, but you just need to be aware of that. Is that cool?
Yeah, very interesting. I've never seen it, but it's going to affect me quite considerably because I'm trying to move a portfolio from, in a company and another company and kind of do a little restructuring. So that's seriously affecting me.
It's big news, and it's going to be a big thing. And I think that we've already been hammered, we're going to get hammered again. So it's just got to keep an eye on that sort of stuff. Anyway, on to tonight's topic of conversation: the current market. Are we going through a boom? When is the bust going to come? What are estate agents experiencing at the moment? How many, we're going to get the guys on tonight to give us a little bit, they're on the front lines, so they're going to give us a little insight into what exactly is happening in the market. I mean, I'm an estate agent myself, albeit at a very small level, and more of a letting agent, but it's good to get the kind of the guys on to talk about the sales as well. And just so we're not all negative here tonight, guys, Stephen is quite good at putting the positive spin on it. So we get loads of people coming on the group saying, there's no deals, there's no deals, there's no deals. Then Stephen comes on, he's doing his flip through in Kinross where he's like, picked it up for mega cheap. So Stephen, first of all, just start us off with this deal in Kinross and tell us, just so we get a little bit of a lift here tonight before we go into the doom and gloom, you know, how did you come about that deal? And, you know, did you pay over home report, etc.?
So it was on the open market, but this was one that I got the offer accepted, I think, a week or two before we went into lockdown. And there wasn't much negotiation with the agent at all. It was a repossessed property. You know, the client was probably getting their guidance from the agent, who was saying, you know, the market's hot, we've got plenty of buyers, we've got a lot of people interested in it. As you can see from the photos we were getting posted on my Instagram story, the floors were rotten in a lot of them. So you had to send a disclaimer to go in the house. So that kind of, you know, as much as a lot of people were looking at it, there wasn't a huge amount of serious buyers. But anyway, it didn't put me in a good position negotiating before it. And I think they kind of negotiated me up quite a lot of the way. And then, like we said before, you don't have to get it cheap. If the numbers work up and you can add the value, then so be it. So I settled at 127 for the property. But over the last 6-7 weeks starting to kind of come out of lockdown, you know, I renegotiate with them and I says, look, I'm not comfortable paying this kind of price. I think there'll be an effect on the market. And the agent says, well, you know, no, what effect on the market? There's nothing going on, basically. And I says, you're smoking some kind of drugs if you think there's nothing going to be happening in the market. And I basically just says, look, I'm not comfortable. Happy to renegotiate to where I was originally looking at. And they basically came back and says, well, you know, it's an executive sale, and here's the bottom line that they're going to take, and it was 121. So got a further $6,000 off it, which wasn't bad holding out for it. Basically paid my ADS and my legal fees, so it paid something. But yeah, there's deals there. There is deals there if you can find the right way of adding value.
Good stuff. And I think that's what we picked up on as well. It's about being creative, adding the value. So, you know, I think obviously that one's going to be a flip. And I think the only thing I worried about people doing flips is how long is the opportunity going to be to exit at a good price? Do you know what I mean? So, you know, we can talk about the risk
of flipping properties as well, as you're always at the beck and call off the market, unfortunately. You know, obviously there's a lot of other factors, including the standard you do the refurb to, and, you know, and the type, location, what its marketplace is. But yeah, the market conditions is going to affect flips, that's for sure.
Cool. Well, let's introduce the guys because they're sitting there patiently. So thanks, guys, for coming on. Let's just go Michael first of all. Michael Maloco is based in Dunfermline. Can you give us a little intro and then we'll go into Chris? Just give us a quick 2 minutes.
Yeah, okay, so it's Michael Maloco, not Jane as it says here, who is my wife. And I'm using her laptop because the mic's gone on my laptop. So I had to use Janie's laptop. And I haven't changed it. I didn't realise before I came on. So it's okay, it's Michael. I'm senior partner at Maloco & Associates, solicitors and estate agents in Dunfermline. I've been a solicitor for 36 years, 34 years in Dunfermline, born and bred Dunfermline. We primarily sales and domestic conveyancing that we do, a little bit wills, trusts, executory, quite a lot of wills, trusts, executories as well. Sell somewhere about 270, in a good year, not a COVID year, around about 275 property sales per annum. And we've got 138 under management at the moment on the letting side. So that's us.
Excellent, thank you very much. And on to Chris, just quickly. How you doing, Chris?
Doing well, thanks. Yeah, thanks, Nick. Just quickly, the company is Portfolio. We are the estate agent for landlords. I was a letting agent for about 9 years and sold that business about 8 years ago. Did a few other things with mixed results. Came back to property, did some sourcing, did some other work around about the private rented sector, working with landlords, and then Portfolio was set up 3 years ago. We pivoted a little bit a couple of years ago, and simply we sell tenanted properties. We sell them usually to property investors. We sell property in Glasgow, Dundee, Aberdeen and Edinburgh and some areas in between. So that's it really. We simply work for landlords to sell their tenanted properties.
Good stuff. And I just wanted to put a shout out to everybody. You pretty much know the format by now, because a lot of you who are on the call tonight are regular listeners. But we like to make this informal, interactive. So we want to try and get the community engaged. We want to try and get the chat flowing. So if there's questions, please put them in the box. I'm sure the guys will be happy to answer them. And if there's any points that come up along the way, then let us know. But first of all, Michael, in your area in Dunfermline, how have you found the last couple of weeks since the property market opened back up? What's the demand been like? Have you got much stock coming on? What do you see? What's happening?
Absolutely bonkers. It started, I'd say, I mean, throughout lockdown, we've been working, flat out. We did have quite a number of people furloughed, but we also had a core who were still working, and we've really been working hard throughout the period. I would say that when the English market reopened on the 13th of May, that seemed to trigger a response north of the border as well, and we started to see a lot more activity. We were doing virtual viewings over Zoom and virtual valuations, and that really took an upward spike at that point. So momentum was really, really building ahead of the 29th. Now, we had thought that we were going to reopen on the 22nd, and we're slightly wrong-footed by Nicola Sturgeon's decision to keep us in lockdown another week. And we'd been saying quite a lot on social media, we reckon this is going to be the day. So we'd been sort of stoking that fire. And so things were very, very busy. And then once we got to the 29th of June and we were back in the office with a limited staff, a closed door policy, things just went bonkers. And of course, the difficulty has been that we still don't have a full complement of staff. I've still got some people on furlough. So since the 29th of June, we've sold 24 properties. Today's the 20th of July. Mm. So 24 properties in those 22 days or whatever. Got another 4 sales that should go through tomorrow. We've opened 74 new files. We've still got 21 properties, we call them HR in progress, home report in progress, so still to come to the market, waiting for photography to be done and for the home reports to be done, and then ready to list. So, yeah. Absolutely, the best market from a seller's point of view, the best market we've seen since 2007, since before the crash.
So if you've got a property to flip and you're aiming at that kind of like, residential market, not the investor market, but sort of residential, somebody looking for a family home, etc., probably as good a time as any to actually sell a property.
Go now, especially if you're in that limit in that area. I mean, a 4-bed, and you can get a good 4-bed in Dunfermline for 250 grand, yeah. And that's now you've saved yourself £2,100 there because of the threshold for LBTT rising. So all
do you think that's had? By the way, do you think that's having an effect already straight away in terms of people selling their properties or people buying? Is it having it?
It's certainly something that's been talked about. We to be honest with you, Nick, we're using it more as a reason for selling, to say to people, look, this incentive is there. And you were talking about, boom and bust, and people talk about, a crash in the market. And perhaps, sorry, Nick, perhaps I'm preempting a question, but if you think about a property crash, you think about crash as a motoring metaphor. I don't think there will be a crash. I think the market, again, to use a motoring metaphor, it may stall a little bit. There may be a bump, but I don't think there's going to be a crash. I really don't think there's going to be a crash. But I think what we're seeing at the moment is that pent-up spring demand, the spring market, spring bounce that should have happened that didn't. So you've got that on top of people staring at the same 4 walls for 3 and a bit months, 15 weeks, and deciding they want to move, or that their current home is not fit for purpose if remote working is going to become more of the norm and you want to have an extra workspace, an extra room or whatever.
That's a really interesting one, isn't it? I've heard that talked about quite a bit, people.
We've definitely seen that. That's definitely been mentioned by people as a reason for moving.
Yeah, and I just get stats out today in my email box. It dropped from Rightmove, and I don't know if this relates more to down south, but anyway, it'll probably filter up here eventually. But stats are like prices up 2.5% compared to, what things were going for in March before lockdown. Inquiries up 75% year on year. Crazy.
I'd say we were up 80% in inquiries. And here's the thing, of those 24 odd sales that are through, and I say there's about another 3-4, which will definitely confirm tomorrow. Our average selling price is currently 106.8% of home report.
Right, so you're achieving well in
well in advance, well over home report.
Are these 24 sales all going to closing dates then, Michael, very quickly? Or
no, we've had quite a few closing dates though, especially on. I thought you might have looked at the one we had down off Aberdare Road. Oh God, one of the former Scottish special houses. I've forgotten the address. Meldrum Court.
Oh yeah.
I thought you might have looked at that. It was a cracking property, and there was a good chance to add a bit of value there. But
I saw the one you added on Carnick just a couple of days ago.
Yeah, it's already had an offer of 15 grand over.
I quite fancy that for myself, actually.
Let's not get too local here, because
I'm glad I've got someone on my side for a change. Usually I'm bombarded with West Side or Aberdeen.
Right, let's bring in Chris then. Chris, let's talk about the investor market specifically, because that's what you deal with, right? You're selling tenanted properties. So, like, from my own experience, before lockdown, I was out trying to buy for myself and investor clients, and I was finding it very competitive already, right? Because there was a lot of people with cash out there, interest rates at an all-time low. Obviously, nothing much has changed. These people have still got cash, if not more cash, because they've probably got bounce-back loans and stuff now as well. So how are you finding it?
Well, it's a different market from Michael. So I think property investors they were really active before lockdown. I think there's a lot of frustration, as I mentioned. I don't know if anybody was there at the start, but a lot of frustration. So in that first day, in fact, we had 3 viewings and 3 sales. And those are people that we've been speaking to in the days leading up to the lockdown being lifted. And that's kind of continued. The numbers that we do are smaller than the numbers than Michael's company does. We're a sort of younger company. I think we've got about 30 properties on the market just now. And definitely the inquiries are up to, I wouldn't like to say sort of March levels, because actually in March, before lockdown, we were finding there was a little bit of nervousness maybe at that stage, more then than there is now, definitely. And so back to kind of January, February figures, and January, February figures were great for us. The investors were very, very keen, and it's really for the reasons you said, probably, Nick. I mean, we don't do closing dates. We just do fixed price property. It's instant rental income. Yeah. And when eventually somebody found out about us, they were like, wow, you've got these properties here. That one looks good. That one looks good. And that's continued really since. Yeah, inquiries up. We're doing probably less viewings though.
I was going to say, so viewings have been difficult because obviously you've got tenants still in the property. So
yeah.
How do you work your way around that?
Well, we're doing less viewings, partly because there are the occasional tenant that is still self-isolating and things, but also we did persuade them to allow us to get in and do some virtual viewing stuff. The Matterport.
Yeah, this kind of like tour, sort of 3D, and you can swing around and
you step over to there, look over, and
yeah,
that kind of stuff. So because it's an investment property, it's not the property they're going to live in, doesn't have to be their forever home or whatever. The investors are happy to buy.
I was going to say that was a question. So you've actually been able to sell without people actually viewing. People have just gone off the basis of that virtual tour. Right, that's good, because like I said to you before, I don't do a lot of sales, and to be honest with you, I was going to chuck it after my Rightmove 6-month half-price membership. I was just going to chuck it and concentrate on the lettings. It's not really my bag, but I took one on there. It was a landlord that was selling, right? It's only been on the market 3 days. Mavis Bank Gardens in Glasgow, 2-bedroom flat, nothing special. I've not even had a chance to do viewings yet. Somebody came in today with an offer $5,000 over the home report valuation and well, they actually came in just a little bit over home report, knocked it back, and then he came back with a higher offer. Owners decided to accept it. Checked the guy out. The guy's working out in Kuwait, lives up in Stirling, etc. Checked out his solicitor. All seems legit. He's a cash buyer, prepared to buy based on, like, I've not even got a video, buying on pictures. So there's definitely people out there like that.
I think if the numbers work, and if they maybe, I don't know if this guy knows the area or the type of property, but
he's got like apparently he's got like 2 or 3 properties in that development already. Do you know what I mean?
Exactly.
So yeah.
So less viewings. It is funny. It is an interesting sort of side effect of sort of COVID-19. Selling tenanted properties with tenants in them, you do have to be even more sensitive of the tenant, and but it's not stopped us at all. Like I say, we're getting sales, and actually the prices that we get. I think, I don't know what the prices Michael said. I think I missed that, but
106%, 106.8% for those 24 properties. I did the sums on Friday, just to see where we were at, because it's interesting. Because obviously, you know, the conundrum for the surveyors is, at what point do they start pushing up their home report values? But they're reluctant to do so because they think there's going to be a correction and there'll be a softening of prices.
Well, that's a good next topic to move on to, Michael. On the kind of home reports and the surveyors, have you noticed any surveyors been overcautious? Have they been undervaluing it all? Have you picked up on anything there?
I think they've been taken aback. I think they started off being really quite cautious, as I think we all were, and then they, you know, they've seen these prices coming through, and you know they're reluctant to reflect them in their valuations just yet, because, as I say, they foresee, as the job retention scheme comes to an end, that, you know, redundancies may start to rise, and obviously that is the factor. I mean, Steve mentioned, you know, I've been in business 36 years. As a solicitor, 34 years here in Dunfermline, and probably about 28 of those at partnership level. And you know, recessions and booms and busts and all the rest of it. The one thing that, you know, if people don't have work, then that's the whole thing kibosh. If they can't get a mortgage, that is it. It doesn't really matter so much if interest rates are at, you know, 3%. Or 13%, as I've seen them. The market will keep moving. You know, mass unemployment is the absolute killer, and that's, there's been a nervousness there from surveyors waiting to see what happens when the job retention scheme ends completely.
Yep, and obviously, like, I mean, it does feel to me slightly reminiscent of, you know, dare I say it, kind of 2007 prices. Do you know what I mean? It's like, it feels like, I know it's not going to be the same because obviously there's not going to be the banks collapsing and all the rest of it. It's going to be, like you say, more of a, you know, mass unemployment, that sort of thing. But an interesting thing here, maybe to have a think about, and Stephen, you might want to come on this one. What about if, obviously, prices are going for well and above home report value over the next couple of months, right? If you're trying to refinance on a buy, renovate, rent and refinance model in, say, 6 months down the line, that's going to reflect quite good for you, is it? Because you're going to have those higher values.
Yeah, especially if you're looking to get all your money back out of the deal, or as much of your investment as you can back out. It could reflect quite good. But did Gillian Green not post up saying that hers was downvalued recently on the group?
Yeah, I think she was a bit disappointed.
Where was that?
I think that was Ayrshire.
Yeah,
surveyors, sorry, I believe, you know, surveyors, they should only be looking at the data that's available over the last 6 months, and that, you know, early part of the year, the market was growing really, really well, and the sales that are completing, the sales that are happening just now won't complete for, you know, maybe if it's a cash purchase, it will be completed now, but usually it'll be another 3 or 4 weeks at least until there's some serious data that will come out, and you know, by then the market will have changed again, possibly, or we'll know a bit more about employment. I think surveyors at the moment, they're putting in some kind of caveat, aren't they?
Yeah.
the valuation gathered during this moment in time. But yeah, employment will be the thing. But there's plenty of confidence now, and I can't see values going down in 6 months' time again because they're looking at data from now. So I'm not sure when that happens. There is obviously some kind of lag, but we'll have to wait and see.
So, like, this is interesting, right? Because we've already got people commenting here, and this is what makes this great, right? Because this discussion tonight, none of us here know what's going to happen in the market, right? We can all have our opinions. We can all kind of say, well, this might happen, that might happen, but nobody knows, right? So we've got Paul Kingham's come in here. So, Paul, give us your opinion, mate. Tell us what you think's, going to happen.
Opinions, yeah, absolutely. Well, just from what the people have said so far, the market's obviously very hot at the moment, and there's a backlog of supply coming through the system, so you're going to end up having quite a lot of properties coming into the market. The market's reliant on the availability of borrowing, which at the moment hasn't been a problem, but the furlough scheme's due to finish at the end of October, and people will be planning for that coming to an end, so there will be redundancies and stuff like that. That's potentially, there's 9 million people, I think, on furlough at the moment. And I think forecasts are saying that, a quarter to a third of them may not have a job at the end. So you're looking at unemployment levels that we haven't seen since the 80s.
Right, okay. Right, let's just focus on who we've got on the call tonight, which we mainly target market it's property investors, right? That probably, most of them will be purchasing, up to about £150,000, probably realistically. In that market, do you think prices are really going to dip that much? Do you not think a lot of these investors will still be there? Do you think more it's going to be like the unemployment rate, etc., is more going to hit the kind of residential market, family homes, etc.?
But I mean, the residential market is where you get your comparables from. So if you're a property investor and you're reliant on residential purchases to make that comparable level higher so that you can refinance your money out, then you are reliant on residential sales not dropping if you want to pull your money back out. Plus, you're also reliant on tenants. If your tenants are losing their jobs and you're not getting your rent because of arrears, there's a whole catalyst here that's potentially brewing. I mean, obviously, nobody knows what's going to happen.
At the moment, part of what I'm stress testing when I'm buying is obviously what the LHA rate is. So, what the universal credit rate is if the tenant is unemployed and has to claim. So that's how I'm making purchases. I'm saying worst case scenario, if they need to go down that route and it's a tenant who's claiming benefit, what am I going to get in for that profit? Is that something that you would think about as well?
Yeah, definitely. I mean, in terms of stress testing your portfolio, the worst case scenario is that potentially it'll be an LHA. But you've also got to think of public spending. At the moment, there's so much money being kicked into the economy that's going to have to get clawed back. So you're talking about benefit cuts, you're talking about employment from public sector roles. There's a whole lot of things that could come into play here that you really need to factor in. So, I mean, and plus the market is, as people have said, it's very like it was in 2007, where people get caught out by what's known as the winner's curse, which you've maybe heard of.
Yeah, thanks. Michael, can you come back in there? I think you want to say something.
Yeah, I mean, obviously, Paul makes a very good point, makes it very well. I don't know if I totally agree with it. A number of things that, an economist that I follow, I've met the guy several times. He revels in the tremendous name of Roger Martin Fagg. And Roger Martin Fagg is a behavioural economist. And he speaks at quite a lot of big seminars and things. And he was also an advisor to the New Zealand government for many, many years. And he's a behavioural economist. So he looks at behaviours and, and predicts what, he thinks is going to happen. Now, Roger's got a tremendous, he hasn't called either a British or an American election wrong since something like 1979. And his figures, when he predicts them, are very much bang on. He's always been a believer in a sharp V-shaped recovery because there's a lot of strength underpinning, even with Brexit, there's a lot of strength underpinning the British economy. There is going to be, even the UK government has made commitment to bring forward infrastructure and big capital expenditure projects and is looking for shovel-ready projects to be brought forward from all of the main ministry, civil service departments and ministries. There is also a school of thought that says, and of course, I don't say this in a callous way, but a lot of the unemployment will come in the under 25s and in the very much the unskilled sector. Not totally, but a good number of them, and they don't drive the property market. You know, the main drivers, a lot of those people are going to be safe. You know,
yeah, I was thinking, Michael, like the industries that are obviously hugely affected are like, you know, bars, cafes, you know, that sort of thing, hospitality.
Obviously, but other than that, it's a lot of kind of gig economy stuff and a lot of student and that type of thing, which doesn't drive the property market, which is why I think there might be a bump but not a crash.
Interesting. Where was I going to go next? I'm looking at lending. Either Chris or, you know, Michael, to get your thoughts on lending and how the banks and the residential mortgages, I think they reduced their loan to values down to 85%, and now I think some lenders are up to 90%. Has that had any effect on potential, you know, buyers driving the market, that sort of thing?
Well, you know, there was obviously, when lockdown happened, the lenders had to deal with it, and there's working from home affected them as well. So they were managing their workload and took a lot of the products away. There were definitely some investors that we were talking to that were in the process of buying property. So it was during conveyancing in missives, and they had to, you know, maybe it had been pulled away from them. They had to go and find a new lender. And the mortgage brokers, I think, have had to work very hard to get the lending for these guys. But it's worked. I mean, we only had 2 sales that fell through. Again, the numbers are, I think we had about 12 properties that were in conveyancing. So what's that, just less than 20% of the sales had fallen through. And one of those sales that fell through, actually, the buyer had got cold feet, and he's now regretting it. He's been back in touch, wanting to, you know, get the property again. So it's, but I think the lenders, the mortgage companies, they're really busy, and everything's going a little bit slowly. But the rates are coming back. I think, was it Barclays or one of the big high street lenders were back and sort of leading the way. Certainly one of them was. And yeah, I mean, money's still cheap and lending's still available. It's not like 2008. This is a different setup.
You know, I think that if you look at going back to listening to Michael there as well, and Paul, obviously very different views. And I'm thinking, where do I sit in this? And I'm thinking, well, if you look at the 18-year property cycle that they talk about, a lot of people will be familiar with. And, you know, Paul mentioned the winner's curse, I think it is, where it's that kind of very last section of it where everybody just gets really carried away, isn't it? And then it just bang, crash. This whole COVID thing just got chucked in there, didn't it? So it's not really part of the cycle. It's just been thrown in there. And with all the kind of stimulus and the money that's been pumped in and the underpinning of the economy and the furlough and all the rest of it, I'm kind of thinking that there might be a little, dip once unemployment starts hitting towards the end of the year, but I can't really see it as a huge crash. Stephen?
Yeah, I follow the cycle as well, and I was thinking the same. If you look at the cycle, we're probably approaching the kind of mid-cycle wobble. So yeah, not necessarily a crash, but a little bump on the road. And you can look back and you can predict on the crash over the years what's caused it, but no one can predict COVID. But there's always something at these times to affect the market. So maybe this is just what it was going to be.
Susan, sorry guys, I see Susan commenting there. Susan Actimel, do you want to come in and have a word? Because you've always got quite strong viewpoints, interesting. You want to have a word? I think you're in sort of Paul Kingham's camp of the big crash.
No, I think I watched 2007 and 2008 and 2009 in real time. I was there actively investing and working my way through that, and I've been constantly working in property ever since. And my sense of what drives property prices are two things: are availability of lending, not even the price of the lending, but the availability of it, and confidence. And so, you know, what we saw, just interesting, Nick, what you were saying there about, you know, we were probably at the winner's curse point pre-COVID. You know, I was starting to feel nervous about the market just before, you know, when you were going to view properties and there was 20 people at the first viewing, things were going to closing date, you know, 50 grand properties were going to closing date with 15 people. Because going, this is getting overheated, and that was pre-COVID. So you can sort of say, okay, well, what impact has COVID had on this? And where we are just now is that everyone is euphoric and hysterical about buying property. And, you know, I think Michael said, you know, we've not seen anything like it since 2007. And a couple of us have talked about 2007. 2008-9 is where it started to go wrong. So if we're at 2007 now, which is absolutely where it's getting hysterical, what is it that happens next? And, you know, what I can remember in the first couple of weeks of COVID was that the lenders all shut their doors. Now, that might be because they were all working from home and they couldn't handle the demand. But all of a sudden, we couldn't get, you know, they pulled products that were anything under, 80% loan to value, everything like that was pulled. So the minute that you know, the minute that and confidence impacts on lenders as well. So, you know, if lots of people lose their jobs, and, you know, I think Paul's completely right, you know, it's the residential market that we're trading in. If lots of people lose their jobs, we'll start to see that potentially on, you know, people with lower incomes becoming unemployed who are our tenants. Then, you know, the rents might start to loosen off. If people lose their jobs and there's a general sense across the country that is a lack of confidence, I believe that will filter through into lending patterns, which will then in turn affect us. And what I see with a lot of, you know, investors that are on all of the different sites that we're all on, everybody is trying to get, you know, these no money left in deals where you pull all your money back out. We were all doing that in 2007. You know, I've got 20 mortgages at 90% loan to value, which are cash flowing great, but the values haven't shifted. You know, if we get to a point that we're all over leveraged, that as well is going to become a challenge. So I don't think there's going to be a massive crash, but I think that there will be a correction. I absolutely believe there will be a correction, and I think it'll hit probably the latter part of this year into January. I think that's when it'll all, you know, just once the euphoria is away and once people actually start losing jobs, which I believe will happen.
I totally understand about your point about, you know, over leveraging and stuff like that. But if you think, obviously back in 2007, it was like, you know, 85%, wasn't it, loan to value mortgages, and really they didn't do any kind of checks. Really, it was anybody could get the mortgages. It was so easy to get, and then you were able to refinance the next day and stuff like that. So, you know, it is a bit tighter, obviously, but no, I understand your points.
Well, I would say also there are properties you know, landlords contact Portfolio, they speak to me about selling their property, and they maybe bought it in 2007, and I have to go back to them and tell them that their property's still not worth what it was in 2007. So they've not, like, let's say they bought it for 90 grand in 2007. Today it's worth today it's worth 80,000. So it's still short of that. So my point being is that, you know, 2006, 2007, early 2008, things got crazy, and the values of properties weren't really based on any fundamentals, you know, employment, investment, local investment, amenities, that transport, all those kind of things. But I feel that now property investors and people buying properties, they're a bit more sensible these days. I know there's a lot of no money in deals and things that go on, but I think that and I've seen, it was maybe about 2 or 3, maybe 3 years ago, specifically in Edinburgh, it was crazy. Remember one spring, stuff selling for 20% above home report value, and it was as hot a market as I've ever seen, much hotter than it is now.
What about this point here? What about this? Sorry, mate. I mean,
I'm responding to you now. That's my point.
Oh, sorry. What about this point, guys? Have a think about this, and if there's any chat comments. Some people have said that the amount of money that banks are putting out just now in terms of, you know, cheap loans, you know, all this sort of thing, in terms of the bounce back loans, And some people are saying, this could all have an impact on lending in the future, and banks could start tightening up if, these are basically government-backed loans. There's talk of this, this might have an effect. Has anybody got any kind of...
Another thing, the cost of this, of everything that's been done, is a fraction of what we spent bailing out the banks. It's a fraction of what we spent bailing out the banks. The Treasury is involved in very serious conversations with the Bank of England to ensure that lending remains, and lending will remain, and that even as all of this and prices leads to inflation, the government have made the decision, this is quite well documented, they have made the decision that they will let the bank allow inflation to rise above its 2 to 2.5% target, but to keep rates low. So obviously the thing normally to choke off inflation is to raise interest rates. But the government have been having serious conversations with the bank, and they're on the same page that they are not intending for interest rates to rise. So again, I think the money supply will remain there. I'm talking about that mainly from a residential point of view. From a buy-to-let point of view, I couldn't say what the reaction of lenders will be in the buy-to-let market. But residentially, I don't foresee that there's going to be a massive tightening up of lending. As you said, Nick, MMR, when that came in, it is now, there's no more ninja loans and all the rest of it, no income and no job and all the rest of it, and you're still getting a mortgage. Those days have passed. The banks are more robust. There's pressure there from the government to make sure they continue to support the economy by lending. And that's why I'm convinced that there will not be a crash. There might be a softening, there might be a bump, but I'm sure everyone knows this. There has never been a decade since the end of the Second World War, where at the end of the decade, never been a decade, where at the end of the decade, house prices were not greater than at the start of that decade. And that also includes 2000.
I see Susan shaking her head there.
It's a fact, Susan. Started 2000 here, went to about here in 2007, dropped back. At the end of in 2010, house prices were still, on average, higher than they had been at the start of that decade. That is a fact. That's a Register of Scotland fact.
Why is Chris saying that he's talking to people that bought properties in 2008? And they can't get their price, the values haven't come back up. That's 12 years ago.
I'm saying per decade. So I'm saying that in 2000 they started here, in 2008 they were there, they may be here now, but in that decade, and once we get to, so the decade from 2010 to 2020, house prices today are now well above where they were in 2010. So in 2010, they were still just emerging from the crash.
I think to be clear as well, Michael's talking about on average as well.
On average, yeah.
So, do you know what I mean? If you look at, obviously, certain locations have been greatly more affected than others.
I think maybe the East Coast has performed better, has come back stronger than the West Coast, because maybe more of an industrial base in the West, for whatever reason, maybe the East Coast has performed slightly better.
We'll come back in 2030, Michael, and see how you got on.
Sorry?
We'll come back in 2030.
That's true. I mean, but it's been 75 years. There's never been a decade where at the end of the decade, house prices on average were not greater than they had been at the start of that decade. It's an amazing fact.
This is good chat, guys. This is good chat. I like a bit of a debate now and again, so that's brilliant. A couple of things that I picked up on with Michael. Sorry, my daughter's trying to get my attention. 5 minutes. A couple of things that I picked up on with Michael, and I think that we need to reinforce this point, that I think we're in this kind of this false bubble at the moment, and until we see the end of the job retention scheme by the government, the furlough kicking in, I think that's a really crucial point. And then we'll start seeing the true impact, the true effect. And then on top of that as well, things need to kind of level off a wee bit in terms of the pent-up demand, right? So this 3-month period, which is now, you're seeing this effect now, all this demand, this rush, we need to let that tail off as well, and then we can really start assessing things, I think. So, Stephen, you're quiet, mate. Jump in and save me. What else?
I'm enjoying everybody else's opinions. You know my opinion from this. I was a young pup in 2007, 2008, my first few properties, and I got burnt pretty badly. So the last year and a half, 2 years, I've felt the effects in the Central Belt of this, and that's why I'm completely in Aberdeen, and Aberdeen's 4 years into a crash following oil and gas prices. So I shut out this market about 18 months ago thinking, no, I'm not liking closing days, I'm not liking 30 people in the same viewing of me, I'm not liking, it just didn't sit right with me at all. I thought I'm buying at the wrong time. So
interesting looking at Aberdeen, because if you look at the home track data that gets produced on Zoopla and all that, it's the only city in Scotland that the prices are down, isn't it, still? You know, and pre-lockdown as well, it was like, you know, prices were still going down up there. It was mental. So really, really different market. Really interesting. There's quite a few people joined in the chat. Stephen, are you able to have a wee look and see if we can get anybody else on?
If anyone's got any questions at all to any of the guests or anyone else, or anyone else has got a point, please just put in the chat or say you want to come on and you can come on.
And by the way, there'll be people here as well, you know, who are maybe feeling a bit intimidated with all this chat about, you know, 2007, and, you know, a lot of people just started in property investing the last couple of months, so they're new to it. Then please give us some questions that we can help you on as well, because that's what we're here for, you know. We don't want to intimidate you with all this chat. Stephen's really good on the group at spinning the positives as well, so he keeps us all motivated. I can be a bit more doom and gloom, but... what else?
Positive to say that, that's why I didn't want to chip in, mate.
No, he's just like that. You're shooting yourself here.
I'm only joking.
Yeah, we're just a happier bunch on the East Coast.
That's right. So Ray Collins, I'll just read out and see. Ray Collins says, caution, I think around LTV levels is my thought. Refinancing, catching this strong market at higher valuations on the BRRR model. Great to get maximum cash back out, but if there's a subsequent fall in values, higher LTV levels might become problematic. Neil Robb has said, something to remember, if you own your own home and become unemployed, you do not get mortgage help for the first 9 months, and anything they now pay will be put on a charge to property until paid back. Okay.
I think in relation to this BRRR kind of model, if you're holding long term, if you're 75% loan to value leverage right now, and we do come into a crash or a correction, it does go 10-15% drop. Is it the end of the world? You're not in negative equity. You can still sell your home for more than your mortgage, and if you're holding on for the long term future, then it shouldn't really affect your strategy too much. Anybody else got an opinion on that?
Sorry, I was reading the comments there.
I know, I was coming back for you to bounce back to you on that one.
Talking about bounce backs, that leads perfectly on. There was a question about bounce back loans and can you buy property with bounce back loans. So just to say, we actually covered this in a specific podcast. So if you go back and look, we did an interview with accountant Brian Wright. And Brian Wright, we were kind of having a bit of back and forth with Brian. You know, we were sort of challenging him because myself and Stephen both got bounce back loans on the record, and we talked about it on the podcast. And although we're not using them as deposits, we're certainly going to use them in our property businesses to try and push forward. So if you want to have a listen, go back and have a look at that. I think where people were coming into problems with the bounce back loans were they were possibly trying to use them as deposits, and then the mortgage lenders were coming back, and obviously part of their anti-money laundering process, along with the solicitors' checks, they were like, well, wait a minute, that 50 grand cash has just dropped in your account. We're not going to lend to you on that because that's basically quite clearly a bounce back loan. So I think there was issues there. But, you know, what's to say you couldn't buy it with cash if it's under 50,000 and you've got a 50,000, but then, there's so much, the bounce back loans are a totally separate thing altogether. We could go on for a whole hour on that. So go back and listen to the podcast. Some lenders looking for 15% deposit for mortgage to go through smoothly. I think that's on the residential market. So Michael, you'll know about, you know, it was like 95%, wasn't it? Like you could quite easily get a mortgage before lockdown.
Absolutely. I think now one of the big problems residentially people are seeing is the people who stayed in the 95% market were HSBC, and they've been utterly swamped, completely swamped. So they just can't get through them all. They can't get the mortgage offers out. So we've got entry dates being delayed because people who thought they'd have their HSBC mortgage through are finding it's going to be late. Nationwide are coming into that market, and so the Scottish Building Society. But again, that's obviously on the residential side. So there are one or two coming back into it. I heard tell that the Clydesdale Bank are going to be probably re-entering the 95% residential as well. So again, I think slowly that'll come back.
Yep, and obviously we just want to reiterate, we're talking about 95% mortgages. Before any buy-to-let investors get too excited here, this is for residential home buyers, not for buy-to-let investors. Buy-to-let investors still sitting at 75% typically. I think there's some that do 80%. So just to kind of reinforce that point. Just reading out some more comments to see if we can get any more topics for conversation.
Neil Robb's put a good couple of comments in. It's probably worth getting him to unmute yourself and come on.
Neil, how you doing?
Don't be all doom and gloom, Neil. Give us
I can do it.
Doom and gloom. Go for it.
No, I put in for about 7 or 8 properties to go and see at the minute, and to be honest, the agents clearly have somebody in line for them because they were on the market. Signs up, sale agreed. I sent an email last week. I went down yesterday, visited the area, sale agreed, sign up, messaged them, and they came back and they basically went, oh, sorry, it's currently withheld from the market at the minute. And I says, well, if it falls through, but you know, it's not going to fall through. It was a great 3-wee houses. I've been looking at for the last 10, 15 years, all boarded up. The guy hoped to buy the rest of the row. Couldn't, obviously gave up trying to buy them now. And he put 3 of the houses on the market at a very good price. The one he completely gutted. So, and then there's another one I'm going to look at in Belfast. One's been on for a year. I bought number 36 and I bought number 32. 34 is on the market. I gave him an offer. The guy laughed at me. Maybe it was the way I put it to him. So I'm going to see that, and I'll physically see it. There's another one on another street that I own, not far away. It's a wee 4-bed. So I'm going to see that on Thursday. But one of the things with this tax review, I know you emphasise the capital gains. It's a far, far bigger picture they're slipping in. And one of the things in property investing and people going into a limited company is you've got a very specific SIC code. And that SIC code makes it so easy for the government. As somebody described it, they've corralled all the private investors in property into limited companies. And then they just need to hit a button and change the SIC code to bring in the same terms and conditions of Section 24. And somebody was saying something about anybody with 10 or less employees will be taxed in the same way that somebody would be if they were self-employed. There's an awful lot of things going on in the background that people aren't aware of. So if you've got capital gains, that's like the main picture. So you're thinking, well, I might have to pay a wee bit more capital gains, but it's what's going on behind that. It's about trying to level out the Section 24, bringing it so it's the same for a property company. People will say it could never happen because company tax was far harder to understand than normal private. But that's what the SIC code is. It's basically already lined it up that if you're a trading company, you're slightly different. But if you're holding property and property only in a company, press a button, same conditions as the done with Section 24, which nobody ever believed, but it'll be done retrospectively, is one of the key things that they're really talking about doing. I always believe Section 24 would have been scrapped the way they've done it down south, because it really did withdraw investors from the market. The properties were crashed anyway, and nobody could borrow or lend. And then they really try to bribe down south of Ireland, to try to bribe landlords back into renting out. And I think that's just something to bear in mind. If you're going to rush into a limited company, pay a lot of money to do it, you might end up just putting yourself exactly where the government want you.
Mm-hmm. It's a good point, and that's why I raised it at the very start of the show. Obviously, keep an eye on the capital gains tax changes, definitely. Right, okay.
Neil wants me to throw the towel on every time I listen to it, Neil. You always come up with the worst possible
Neil.
variation of what's going on. I'm like, oh, God.
Hey, but I tell you what, doesn't matter how bad this gets, I'll come through it.
Exactly.
That's the point. I built strong foundations. So if this goes on for 3-4 years, if half my tenants didn't pay rent, I would still be sitting here reasonably okay.
Because you loan the value, Neil, or because you've still kept them in your own personal name?
No, I bought it at the right time. Most of the stuff I want to own outright. My borrowings are quite high, but not very high in comparison. That sounds a wee bit sort of thing. But it's all about knowing that if things go wrong. Like, I thought I'd only 8 properties sitting empty over COVID. I'd actually 9, but I still done okay at it. And then the few tenants that didn't want to pay, I managed to convince nearly everyone bar one to pay. So everything worked out fine. But all these little changes.
I think that's a really good point. And just, I mean, I've been like super surprised. I mean, we're not out of this yet. We're not out of the woods yet, by the way. You know, I've been like really, really surprised at how well tenants have reacted and how little rent arrears I've actually got across a portfolio of 100 properties. I mean, I think I've probably got 6 cases of rent arrears, and not all of them are 100% non-payers. Do you know what I mean? Some of them are only, you know, they may be paid 70, 80% of the rent. Hopefully we'll claw that back in the payment plan. You know, I've been really impressed, and from my own portfolio point of view, you know, I couldn't have thought, I mean, I just think buy-to-let, boring.
You've got to thank Rishi Sunak for that in the furlough scheme. That's why. When it comes to an end, that'll be the real telling point for your tenants. But I mean, the furlough scheme has been an absolute godsend.
Absolutely, 100%. Like, landlords have basically been underpinned by the government, and my income has been, I never had to take any help in terms of, you know, furloughing myself as a director of my company or anything, because I had that income still coming in. So, yeah, 100%. And like you say, the real effect will be at the end of the furlough scheme. We're coming to the end of the hour mark. I don't want to keep the guys too long. Michael, is there any other, or Chris, is there any other points?
I was just going to ask about people's thoughts on what's going to happen with the 6-month notice for tenants. If anybody had an opinion on that. Obviously, not that popular, I guess, in some ways. And it is true that tenants have been really good. I think landlords have been really good throughout the whole time as well. You know, very understanding of tenants and work well together. But so it's review meant to end in September, isn't it?
It's the end of September, yeah, and it's this was the emergency coronavirus bill that the Scottish Government kicked in very quickly, and it basically said that, well, with the PRT, there's 18 different grounds that you can evict. Basically, some of the notices were 28 days previously. I think the rent arrears one is 28 days notice, and then if you have to go down the tribunal route, if the tenant doesn't vacate the property after 28 days, then you can be, I think you have to be 3 months in rent arrears. Over a period of 3 months, they have to be in some rent arrears. And then by the time you get to the tribunal hearing, you can be like 4 or 5 months, sometimes 6 months down the line. So what they've said now is that it's got to be 6 months before you can get the tribunal hearing. I think that's right. There's been so much that happened over the past few months. My head is totally fried with it all. But yeah, like you said, 6 months, and I think that they had to do it. They had to do it. You know, I think they couldn't have done anything else. But I think the problem is, what are they going to do in September? Because they're going to need to review that. Do you know what I mean? So what are they going to do then? Some people are a bit scared to say that will stay like that, you know, and I don't think they can do that. I mean, that would just be ridiculous. Anybody else get any views on that? Neil, you're always quite good at the evictions in the first tier tribunal.
First tier tribunal. I've never had to go to it, thank God. I smile when somebody walks up, owe me $2,000, thinking, yes, I've what's in. How bad is that? The tribunal system, as you were saying, that it's 6 months in arrears before you can send them the letter. Then you've got to apply for it. Then you've got to go through the process. Now that process, before they even decide if you're going to have a hearing, was backlogged to 6 or 8 months. So there's your 6 months in arrears. You're then applying for it. You're then waiting 6 to 8 months, even more, to find out if you're going to get a hearing. Then you get your hearing date. He turns up and says, broken light switch, case adjourned. Let's get the evidence.
Oh my goodness, what have I started here? Oh my goodness.
Do you know what I mean? It's laughable.
Yeah, I think really it's about how you manage the tenants. I've got a lot to do with this as well. You know, I think that if you're on the case, you know, you manage them, you're helping them on universal credit as well. I think you can really help the situation if a tenant does lose their job. Like, I'm very proactive with my tenants. Some will just literally shut down and you can't help them, then that's a problem. But if you're actively giving them solutions, i.e. get yourself straight onto universal credit and get in the system, and they will basically pay your rent. It's as simple as that.
It's very important when you're doing that, though, Nick, to understand when they get their advance payment, the first advance payment is to help pay for the first month's rent while they're waiting the universal to come through. They're clearly told that, but they pretend they don't. They then say, no, I borrowed money. I don't get my rent money yet. So they immediately fall into arrears, which was causing some of the crux. So you, as a landlord now, can actually apply for direct payment. If somebody's ever been evicted, if somebody's ever had money problems, if somebody's an alcoholic, drugs, or addiction or mental health issues, you can apply straight away from day one for direct payment. A lot of landlords apply and get told no. If you get told no, you know that I had a gambler once, straight back in and get it.
Okay, mate, nice one. Thanks very much. Somebody going to mute Neil now. He's had his 20 minutes airtime. No, really appreciate it, Neil. Thanks very much. That's brilliant. Right, let's wrap this up. Let's get everybody, out of the 4 people that we've got on the panel, I'll go first. Let's just get everybody's summary on what the market's going to do over the next 12 to 24 months. Like, we're all just winging it here. Nobody's got a crystal ball, but based on, you know, experience, like people have got experience here, what you think is going to happen. I'll go first. I think obviously things will be very, very competitive, and we'll be living in this mini fake bubble up until the job retention scheme ends and basically people come off the furlough, and then unemployment rate will start going up, causing a slowdown in the market, hence having a knock-on effect on prices. Prices will go down towards the end of the year. I think they will remain quite low through 2021. I don't think it'll be a huge crash, and then I think it'll take off again, and I think it will take off again sharp once businesses get themselves together again, and the economy starts picking up. I think it'll pick up quite quickly. So people are asking, should I hold off? Should I not invest in property? I'm saying to people, if you're investing for the long term, which I always advise people to do with buy-to-let, it's not a get-rich-quick thing. Buy-to-let's a 20-year strategy. You're buying for 20 years, you're holding, you're not getting rich quick. I'd say even if we drop 10% in property price value over the next couple of years, like Michael said, if you look at it on average figures, at the end of each decade, property prices are always going to go up and you always make money. And I think it's a great strategy, and I recommend anybody to keep going. I would say probably hold off for the next 3 to 4 months and see it just until this pent up demand wears off. Anyway, that's enough from me. Michael, on to yourself. Give us a wee rundown summary.
Yeah, if I was looking to sell, I'd sell now. For you guys, mainly people on here looking to buy, I would hang off. Because I think prices will soften. I think the job retention scheme coming to an end and Brexit will have an effect. I think one of the biggest effects on potential future house prices is the constitutional question in Scotland, and that will have a detrimental effect. It will very much put the brakes on the market. If we look like we're heading towards an Indy Ref 2 situation, I think that's a definite. I think house prices, again, no one knows if there'll be a second spike, second wave in coronavirus and how that might pan out. I think that in the spring, so I think prices will start to soften. The demand will dissipate a little bit, and I think by next spring the market will be back onto a more even keel, and that prices will then start to pick up again slowly.
Thank you very much. On to Stephen.
I would, how can I add to how elegantly you guys have put it? I would personally, if you're investing or looking to invest, don't be a motivated buyer. Right now, everyone's keen to go out and get a property and get a deal. And if they're setting themselves out goals at the start of the year to add 5 properties to their portfolio or flip 3 this year, because we've had this 4 months of lockdown, we've not had that bit of action or goals. Don't be that person that's sitting there motivated, just hungry to get a deal and trying to fudge to make the numbers work. Just ignore all the noise and do what you feel is right. And look at it. Property's a numbers game, and if the numbers are working for your deal and you believe that you're buying right, then buy right. If not, hold off and wait for the better opportunities to come.
100%. Chris Woods.
What you said, Nick. No, I think that a year from now we'll be broadly where we are now, if that makes sense. There'll be a couple of waves in that time due to unemployment and other things, but it will just be a bump, if anything. And then after that, so in a year's time, the tail end of 2021 will be very, very strong. But in terms of should property investors buy just now, I think, yeah, you should, but just as Stephen said, don't get carried away. So if you're buying, take the long-term view that you said, Nick, but just buy something around about home report value.
Yep, 100%. And obviously people who are getting pissed off with going, getting involved in closing dates and all the rest of it, they can approach you and basically you'll tell them exactly the price that the vendor's wanting for it. A much more straightforward approach. So where can people get you, Chris?
Portfolio, so all the W's, portolio.co.uk, or Chris at Portfolio. I could put it on here just now if that helps.
Yeah, put it in the chat. Michael and yourself, if people are looking to sell their property, I take it Dunfermline area.
West 5, sort of KY11, KY12, KY4, 5, and 13 postcodes. Find us on Facebook, a lot on social media. I was looking to engage and increase the reach there. So just Maloco and Associates at Facebook, and just all the W's, maloco.co.uk for our own website.
Thank you very much. I'd like to thank Chris and Michael very much for your time tonight, guys. You've been really great. Managed to spark a bit of debate there as well, which is always good. And I like that. I like strong opinions. So, I'm sure Stephen will like to say thanks as well.
Yeah, superb, guys. Thank you very much for taking your time out to join us tonight. It was really, really good.
Yeah, thank you. Thanks for inviting me. Happy to come back anytime.
And just to wrap up, guys, as always, we release a podcast every Friday. It's a Scottish Property Podcast. You can get that on all platforms. This week we had Arshad Ali on, and I think Arshad's on the line tonight. So go and check that out. It's really interesting. He talks about fear and risk, which hold a lot of people back from making their first investment. So he talks about that. It's really interesting. We'll be here every Monday, 8 p.m. For the foreseeable future, probably for the next month or so. And we're always looking for more guests. So if anybody wants to volunteer and come on, then we happily have a chat. And head over to our Facebook group and we continue the discussion over there on all things property related. Bye for now.
Thanks, guys. Cheers.